Welcome back, momentous family. Today we're going to be talking about the multifamily market, specifically the massive $230 million foreclosure down in Houston, Texas. Really big deal. This video is going to talk about three things. Talk about the main problems that went wrong in this Houston deal. Then we're going to talk about multifamily in general in 2023 and what we can expect, some challenges that are going to be facing it, and then the possible regulations that might come as a result of failures of this magnitude. As always, please give us a like, share, and subscribe as we dive right into this content and we follow up. So let's dive into this deal. Okay, so let's start with what went wrong in this Houston deal so you guys get an outline of the actual problem. So it's a $230 million, 3,200 unit deal joined together. And what that means is that there was a foreclosure on the property. They foreclosed on the loans that were out on it. And basically this happened because of one, low reserves. Why would an investor have low reserves in their property? It increases the returns for the investors because they need less money in the deal in order to get the same amount of returns. More returns on their exit strategy and more cash on cash returns throughout with the rents and everything like that. Then we have the sad case that this just wasn't managed correctly. We have bad operators chasing high returns, chasing appreciation, poor underwriting on the deal. These operators were actually given loans to buy another 1,000 units as part of this deal while they already had 3 properties under foreclosure. So not only were these investors chasing using faulty techniques to acquire these properties and then manage them through the life cycle, they're also getting approved for loans while they were actually underwater. That brings us to the third point, bridge debt. So they were on bridge debt, which is, these short mortgages that are 2 to 3 years long. And investors do this to really try to maximize the returns in this 2 to 3 year period, get that NOI up, and then sell it really, really quickly. So basically it's a math game of cap rates, NOI, and then trying to get that overall selling price after they do that. So they might raise the rents by $50 for 100 or 200 units. That increases the income. They might decrease expenses by a couple percent, and then voila, you play with the numbers and you just made $1 million of theoretical value to that property, which is good, but it creates issues when it's not real value. And then secondly, we have broker greed, which the brokers, they make a percent on each loan they write. So this spiral of continuing the debt, kicking it down the road, kicking these issues down the road in order to chase the returns, the operators chasing their acquisition fees, the brokers chasing their lending fees, and the banks not wanting to accept it, and they keep issuing loans. How does this happen for LPs, and how do these deals actually go through? The LP should definitely be doing their due diligence. These limited partners that are investing in this deal, they should be identifying these properties, looking over the numbers, and then also looking over the general partners and what they're actually doing in their current investments. They would have been able to catch the fact that maybe there's 3 other deals under foreclosure, how are their other deals performing, etc., etc. But the sad reality is that the general partners are very, very good at marketing. In today's world, marketing goes into, maybe they're getting on their private jets, maybe they're going on a private vacation, showing off all these great things and great marketing pamphlets, videos, education, all these different things, beefing up their expertise, where in reality, it's all for show. We see this a lot in the sports industry, in the music industry, where artists or players are caressed and brought on all these great deals, these parties and everything. The managers take all their money, and the artists or the players are left with very, very little percentage of how much money they actually make. It's the same thing with LPs. So this deal is actually being finished off with other investment firms that are buying out these units. Some of the banks are taking back these units under foreclosure. Basically, they're buying them at a discount, and when they buy them at a discount, they will actually cash flow and be able to manage them better for the future. So it's not like these 3,200 units crash burn, but what happens is the LPs lose money, the banks basically just get their money back, and that's the sad reality. So let's transition into the second part of this video on what this means for the actual multifamily industry going forward. So we've seen a lot of interest rate hikes, and what happens is that most multifamily homes are actually with regional banks, about 60-70%. They are on, a lot of them on variable debt. So in some cases, we see firms, property deals that might have signed on with a 3.4% interest rate, and they might be getting hit with 8% now after all the hikes, after the years and the progress of that variable rate debt. Now the problem is that might actually be $300,000, $400,000, $500,000 or more in the debt service. So a property that was previously cash flowing is now net negative month to month to month, year over year, creating issues, eating up the reserves, calling capital calls. Likewise, how does that deal finish out? Well, if the debt service is massively up, the actual cap rates are going to change and the deal is going to be worth less than it was projected to be, decreasing the returns for the limited partners and also affecting the exit strategy of the deal itself. Overall, we've been seeing some operators chase these returns of appreciation that we've been seeing over the last 10 years and really just kicking the can down the road, doing these nifty techniques with the numbers in order to get returns very quickly in the 2, 3, 4 year mark on these multifamily properties. Some of these investors that aren't having sound techniques and actually adding value to the property and actually transforming it and raising it up, they're going to see the hits. Those are the ones that aren't going to be doing well during this high interest rate environment when their note comes due. What we see going forward in the rest of the year, we're probably going to see a few more of these where, firms don't have sound investment strategies. So there might be a few more large foreclosures like this deal down in Houston. If this happens, what we project is that, the SEC and different regulating bodies, pretty much the SEC is going to step in. They're going to, kind of crack down on this, add more regulation. As of today, 506C and B only require about a 1-page filing document to get it in, and there's really not too much double checking how much your investors, these different accreditations. You really as an investor just have to keep that on file just in case. So we see higher regulations coming forward if these property deals start to crack down and start to hit the headline news, because this actual Houston deal is making strong headlines, as it is already in the Wallstreet Journal a couple weeks ago. So going forward, I think that there is still tons and tons of good options in the multifamily market coming on board right now. I'm actually super optimistic because when we see deals like this, that means that there's problems to be solved. There's discounts to be had. There's ways to help people out, because when you see a foreclosure, it might be someone's pain, but there's also an opportunity to alleviate their pain to get them out, right? So tons of opportunity coming on board. And that's what we want to share with you today, is this Houston deal and its reflection on the actual larger multifamily market. In the coming time, we're gonna have more videos on this. If you have any questions, please drop them below. We'd love to get them answered. This is Patrick Robertson with Momentous. We'll catch you on the next one.